This is Gaysa Radio, and we welcome back Yehu, our tax expat, tax guru. Welcome back, Yehu. I hope you are keeping well. We're just going to ask you a couple of questions again, just to let us familiarize ourselves about what expert tax is, expat tax, what to expect, and what we need to know more about.
Thank you so much,
Welcome,
and wonderful. Thank you so much, Livia, and thank you. Welcome, and I appreciate being called back. I really appreciate it.
What is South African expat tax, and how does it differ from regular income tax?
Okay, so interesting. Thank you, Livia. There's no real expat tax. In itself, it is not a tax. It is just a term that was granted for the new rule, which started on the 1st of March 2020, that says any expat that is more than 183 days out of the country, of which one trip is 60 days, that person will pay tax, so-called expat tax, on the income in excess of 1.25 million rand. 1.25 million rand. When it was announced, it was 1 million, but they later upped it to 1.25 million. So the first 1.25 remains tax exempt. And that's not applicable to seafarers. They have a total different rule.
Who qualifies as a South African expatriate for tax purposes?
Livia, that's very important because you must be a South African tax resident to claim that exemption, okay? So you need not be a South African national, but you must be a South African tax resident to claim that benefit. That means that South Africa is your home, where you are paying tax on a worldwide basis. And because you pay tax on a worldwide basis, the income that you earn whilst outside South Africa is then taxed, provided it exceeds 1.25 million. But very important on this topic is that once you've met that 183 days, a lot of people think that you now become tax non-resident. In our country, it's not that easy. In other countries, we have a 183-day tax residency rule, but not in South Africa.
Can you explain the concept of tax residency in South Africa? And is it important for expatriates?
Extremely, extremely important. So, Livia, we have this strange law that the definition in our tax law refers to the word resident. We have just colloquially and you know, as the gurus in the field, we use the word tax resident, but the word is resident. So any person who's resident is a person that is ordinarily resident. So I'll explain that a little bit later because I probably think you're going to ask me about ordinarily resident. But ordinarily resident is that where you'll return to the end of your journey. So it's a brief discussion. We can discuss it a bit later. The other person that could be tax resident is an immigrant, someone who was not born in South Africa typically, came in on a work permit. They don't have a permanent residency permit. So they're not here forever and a day. But once they've been here for 6 consecutive tax years, not calendar years, tax years. Remember that runs from 1 March to the next year's last day of February. If they have been in the country at least 91 days for all of that 6 years. Okay, now the 6 years, the current year. So let's look at our February 2024 tax year. So now if you've been here since 1 March, you've met the 91 days in this tax year. Then you must look at the 5 tax years prior to this year. So now you look at February 23 tax year and 5 years prior. All of them, you must have been here 91 days. So it's called a 5-year test. And in that 5 years, in total or aggregate, you must have been here 915 days. Now, 915 days. If you divide that by 5, it gives you an average of 183. Okay. So the requirement is not 183 days. The requirement is a minimum of 91, but in total, 915. So you can have 1 year of 365 days and 1 year of 91 days. And if they all add up, after 5 years, you're tax resident. If in the 6th year, you've been here 91 days. So for example, say you've been here since March, then it's normally March, April, May. So at the end of May, it's a bit more than 91 days, but on the 31st of May, you become tax resident backdated to 1 March. So those people are tax resident because of the what we call physical presence test, their tax residency always starts in the first day of the 6th tax year.
What is the exemption threshold for South African expatriates, and how does it work?
Okay, so for those that are not seafarers and not able to claim a treaty, the threshold is 1.25 million. That's the exemption per year. That 1.25 is not a portion per month. So if you went out and you started working outside of South Africa 1 December, then in that 3 months, if you till end of February earn more than 1.25, then you pay tax. But normally you can claim that full 1.25, although you've only been out for 90 days. But we have another threshold, which is roughly about 90,000 Rand. So if a taxpayer has no other income, then it's strictly speaking the 1.25, which is the expat tax exemption, plus the unilateral tax threshold in South Africa for about 90,000. So then it could go up to above 1.3 million, but work on 1.25, that's the safest, because most South Africans who are expats probably have a property to rent out, and that 90,000 is the exemption that is available then for their rental income.
Are there any tax planning strategies for South African expatriates to minimize their tax liability?
Oh, absolutely. The first thing is we look at our law. Our law then says you must be out of the country 183 days, of which more than 60 days must be continuous. But now, interesting, that 183 days is not a tax year. So remember, coming into South Africa, it was exact tax years. When you're an expat, it is any 12-month period. Okay, so I'm going to try and use an easy timeline. If you leave 1 January and you come back 31st of December, then the last 2 months, November and December, makes up more than 60 days, okay, because it's 61 days. Now you've done your 61 days. And because it says in any 12 months, you can now work from 1st of November of this year forward again to 31st of October, 2024. With the result is that you only have to do 60 days in the 22 month cycle. Okay, so it's a very interesting concept. The second part is, if I take you back to that definition we had about a tax resident, you're either ordinary resident or you've been here 6 years. Then our law says, but if you are deemed to be a resident in another country, or treaty country, then we can exit you. We can remove you from the tax system as a resident. You remain, your tax number stays, but we remove you as a tax resident. Then your total foreign income is exempt. A non-resident only pays tax on South African source. But there's a price. When you tax immigrate, you must pay an exit tax on your unrealized gains.
Are South African expats required to pay tax on their foreign income?
Absolutely. Any tax resident. So the minute you're a tax resident, whether it was because of the physical presence test or whether it was because of the ordinary resident, you pay tax on your worldwide income. There's a few exclusions, but they're very few and very, very particular. So the general rule is tax residents pay tax in South Africa on their worldwide income.
What are the tax implications for South African expatriates who work abroad for an extended period?
Those are the guys who typically can then tax immigrate. If I use an example, if someone goes to the United Arab Emirates, they have no tax. Okay, so they are going to pay tax in South Africa unless we tax immigrate them. The terminology we use, cessation of residency. So cessation of tax residency. You're not giving up your passport. You're not giving up your right to come back. It's a year-by-year tax non-resident status. They can then, once they meet the UAE test, which is 183 days in their country, they must have a rental agreement in their country, and they must have a valid work permit, employment, and interesting, they have a credit score. You must have a bank account of good standing for 6 months. Then we can tax immigrate you. Then they issue you a tax residency certificate, TRC. We submit that to SARS, and SARS takes you out of the worldwide basis. Then you remain as a taxpayer in South Africa until the day you come back. But in that period, you only pay tax for that extended period on the property you rent out.
Can South African expatriates claim tax credits for foreign taxes paid on their foreign income?
Oh, absolutely, Livia. So if you are earning more than 1.25, and now let's use England, you are now in England paying a tax rate as high as 51% at certain times. Okay. Our highest tax rate is only 45. Therefore, someone who's an expat tax in the high level of, so they have big owner in the UK, bankers and lawyers and so on, they can claim that UK tax, but only the part above 1.25 million. So because SARS throws away the 1.25, they don't tax you on that, the tax on the first 1.25 million is ignored. Then the tax on the excess can be a tax credit in South Africa. But very important is to understand, in UK, for example, people look at their payroll taxes and they want to claim their national security tax and national health tax. Those are not credits. It's the pure income tax that they pay to His Majesty, we must now say His Majesty's Revenue and Customs Services.
How does South African Revenue Service determine an individual's residency status?
They don't do the test. It's up, you're obliged to go as the taxpayer and say, I have tax immigrated. Okay. Then you go on the SARS system. The e-file is wonderful. It's one of those government departments that works well when it comes to online. That's why I'm so digital. I spend 6 months a year in Dubai because I can do it from anywhere in the world. Once you go on the RAV, just the static data where your address and things are, and you say you're non-resident, you put in a date. Then SARS will immediately trigger a query to you and say, I want from you your balance sheet for the last 3 years, your exit tax calculation, because you must now pay tax on that assets you hold. Then they want what we call TRC, that tax residency certificate from the foreign tax authority. Then they want to know how often you come to South Africa and why, because you can't claim being tax non-resident, but you spend most of your time in South Africa. So a TRC is the 80% of the convincing facts, but they have some other small facts that they look at. In a double tax treaty, it then goes and says, and a double tax treaty stands above our law. And it says, if you're now resident in the UK and you're resident in South Africa, there's a tiebreaker system. The first tiebreaker says, you will be deemed to be solely resident in the country where your permanent home is available. So the two words is permanent and available. That permanent is a 12-month period. So if you have a rental contract for 12 months, it's permanent. Available, a rental contract is good enough. It need not be your own property. If you have a property on both sides, you have a holiday in Camps Bay, holiday home in Camps Bay, and you have the small little apartment in England, we don't look at the size of the apartment. Our next step is center of vital interest. So if you and your spouse, and remember in South African tax law, same-sex spouses, even if not married, is a spouse for tax purposes. If you and your spouse are living together and you're both employed abroad, your center of vital interest is UK. If that can't be determined because one of you are sitting there as a digital nomad working back to South Africa, the next test is what we call habitual home. Now, there's this big court case. I was not involved with it. I would have loved to be, but Jonathan Oppenheimer, the well-known Oppenheimer, has had a tax court case in England because England said they are resident England. They went on this habitual home and center of vital interest, the Oppenheimer family, and said, no, we have a house in the UK. Our children are at school in the UK. But at the end of the day, our center of vital interest remained in South Africa because they keep on coming back here and there's no employment. They stayed in the UK for a purpose, being the children's school. So it's very important that these tiebreakers are not as easy as we think. And but SARS normally accepts our tax opinion. So if you come to me, I write you a little opinion in terms of the Tax Administration Act, Section 223 says, if I write you a tax opinion, and I say, I think in a court case, the court will find you non-resident, then SARS generally accepts that.
What types of incomes are subject to South African expat tax, and what are applicable tax rates?
Okay, so first of all, when we are dealing with the normal taxpayer who just goes out the 183 and 60 days, then it is a list of income, which is in the Act and specifically specifies it. And it includes share incentives. So if you, for example, if you work for a private company listed and you get share incentives, you can also claim that share incentive as exempt as part of your salary up to 1.25. But if you're a seafarer or you're a pilot in, for example, Qatar, UAE, Singapore, a few of those well-known aviation countries, then you're totally exempt, okay, on what we call remuneration as defined in the 4th schedule. Now, for people who don't know, that's the one that determines how much tax gets paid on your payroll. So for those people, it's the actual payroll, the total amount on your payroll, but nothing more. For the people on the 183 days test, that is not always the full remuneration. It's the majority, but there's an odd few that are not exempted. Okay. So the one thing that we often find that puts people over the threshold is when you are working, for example, in Qatar and the company, the hotel, they gives you free flights to and back from South Africa. SARS tend to tax that. I don't agree that it's correct because for me, it's like a business expense. SARS says any expense from your home to your place of employment is private and taxable.
Are there any tax treaties between South Africa and other countries that affect expat taxation?
Yep. So we are probably the 3rd best treated country. So we have all these. We have a lot of tax treaties. Okay. And they've just been updated, all of them, on the 1st of July, which we call the multilateral instrument. So SARS has updated all the treaties at one stage, get all the countries together to agree. So these MLI updated tax treaties are applicable to all our trading partners. The one or two that's, for example, not there that we miss is the Philippines, Panama, but all the other countries, Australia, New Zealand, we have one with Zimbabwe, you won't believe, we have with Namibia, we have with America, and then we have 3 very important treaties that deals with a state duty or tax on death, and that's UK, USA, and won't believe it, Zimbabwe.
Can you explain the concept of ordinary resident for tax purposes in South Africa?
Okay. So interesting, it's a very, very controversial term. It's not defined in our law. It is referred to in our law, but it's not defined. So SARS has issued Interpretation Notes 3, and they've updated a few times to say what is ordinarily resident. So what they look at if determine if you're ordinarily resident is, the first one is where you will return to at the end of all your journeys. So it's a common law principle. If you are out in a treaty country, but you will one day come back to South Africa, or you'll be forced to come back because you have no second passport, then you remain ordinarily resident. Now, the practical implications is during your working life in the UAE, tax exempt on everything outside South Africa. But if you die in the UAE because you can't get a permanent residency or passport there, then for stay duty, your worldwide assets are taxed. So there seems to be a conflict, but we live with it. But however, if you can show that you have the intention and the ability not to come back, and your lifestyle shows that, for example, you have gone to Portugal, you have upgraded from the golden visa to a permanent EU visa or a passport, and you only come back to South Africa to attend to family affairs, then you are ordinarily not resident because your South African visits are incidental. So small things that SARS look at in a specific court case that everybody always quote, the OK Bazaar's case, they looked at the guy's religion. No longer can we look at religion because we're a secular state. So we now look at things like social clubs and things like that. If you remain politically active in South Africa and all your social clubs, all your religious affiliation, all your cultural relationships are South Africa, then there's probably an indication that you're coming back. You may say my intention is not to come back, but your lifestyle gives you away. So it's very important, intention, lifestyle, and ability.
What are the tax consequences of returning to South Africa after a period of working abroad?
So let's assume that you tax immigrated. You paid that exit tax. Now you've earned all these dollars. You built up a portfolio. If you, for example, have shares or unit trusts that's worth the market value on the day you come back is 10 million, then SARS can only tax you from 10 million upwards. So we call it a rebasing of historical cost. So for capital gains tax, the amount you paid is always deductible. But when you immigrate with an I back into South Africa, it's not the 3 billion you paid, it's the 10 million market value. And then from that date onwards, you start paying tax. Because you were born South Africa or you were previously in South Africa, then your tax year starts on the day you come back. Then it doesn't start on the 1st of March. That 1st of March rule is only for the people never born, and not born and never born. Not born in South Africa, never lived here before. They start on the first day of a tax year. But if I go out and I come back, it's the day that I come back to South Africa.
Are there any tax planning strategies for South African expats to maximize their tax liability?
Maximize or minimize? I assume it's minimize, but let's look at it.
Oh, minimize, sorry.
Yeah. No. No one wants to pay too much tax, believe you me. So for example, one has to look at what the tax treaty provides for. So we have every tax treaty is different. There is a model in the world we call the OECD model or the United Nations model, but not all of our treaties follow that because some of the treaties are extremely old. So for example, in the UAE treaty and Qatar treaties, those comes from the 90s and 2000s, they're very young. There's a provision that if you are a pilot or crew on board a ship or an aircraft in international travel, so for example, you work for Etihad or Emirates or Qatar Airlines, then South Africa cannot tax you. Only that country can tax you, and they opt not to tax you. So it's very important. So people that are going to, for example, as crew, so whether it's pilot or onboard crew, to broodjie technicus, you can still claim an exemption. You don't have to tax immigrate. But if you go to England and let's use America because it's very big. If you go there as a pilot or crew, now we don't have that clause in the American treaty. Now it is better to tax immigrate. So we have to do that kind of planning. Okay. Then also, if you, for example, are going to England and you're only going to create a business there, so you open a branch that side. There's certain circumstances, it's very complex to explain, but certain circumstances that allows UK to tax the branch and South Africa can't tax the branch. We can only tax the head office. So let's make it practical. You have a software company. If you sit in South Africa and you export the licenses to UK, then it's taxed here. But if you feel that the program you're selling needs a bit of adjustment because you need to have UK rules taken account because their bank rules are different, their currency are different, they don't have exchange control. Now you create a branch and you take a separate program or you adjust your program and you create a branch and your UK people buys from that branch the license fees. Okay, then that branch income can only be taxed in the UK. South Africa can't tax. But the royalty fee that you get is taxed in South Africa. Okay, so it all depends on what type of income. So when you want to do some planning, I need to know which country, what business, self-employed, or which industry you're being employed. But there's lots of opportunity. And that's my main business. That's why I can sit in Dubai, work remotely, and I help South Africans in Australia and things like that. One of the other practical examples is if you, for example, are close to retirement, and your children are all in Australia, then you can actually move to Australia and your pension that you receive in South Africa will be tax-free in South Africa and only taxed in Australia. Now, their tax rate's a little bit lower than us, okay, but it could be advantageous. The Reserve Bank is also so kind to say, if you then live that side and you have an address that side, so it's not just a holiday, you have a FICA address, then that money can freely transfer to the Australia or America or US. So it's very important that I need to know a little bit of a background, but there's lots of planning opportunities.
How do offshore assets and investments impact South African expat tax?
Those always remain taxed here. So remember we said that remuneration or the list of income from employment is exempt, but never, expats can never claim exemption on their foreign investments. That interest and dividends are always taxed. But to give you a practical example, if you, for example, have a portfolio of shares and it's based in America, they withhold 15% tax on dividends. We only tax dividends at a flat 20%. Then you just pay in the 5%. You can't claim that exemption because you're an expat. Okay, it's not possible. But the interest, there's no withholding tax on interest. So then South Africa has the full right to tax you on that interest.
Can expats claim deductions or exemptions for expenses related to their foreign employment?
Oh, absolutely. So it depends again on the country, but the first one that comes up is our tax law says unilaterally, if you pay a medical aid that quacks like a medical aid in South Africa, you can claim that. Secondly, if you contribute to a pension fund in that country that is similar to a South African pension fund, so it's duly registered and so on, you can deduct the contributions. But remember, if you've claimed the 1.25 million, then there's no purpose in claiming the pension fund. Okay, so you must just be mindful of the fact is that you can claim it, but don't try and claim it if you claim an exemption. Okay, so you must first have the income, then you can claim the deductions. Then we have a unilateral rule that says, if you don't want to claim the tax credits, the tax you've paid that side, you can claim the tax paid as a deduction to determine your taxable income. Very few people will do that. But for example, if you have a very, very high tax rate in a foreign country, like a flat rate, it's sometimes better to claim that as an expense. The other typical expense is we have a rule that says whatever you earned as a trade income or commission. So you're an estate agent in, for example, UAE. Now you can't qualify because it's not remuneration. Now you can't qualify for the 1.25 million, but all your expenses, car expenses, like you would have been able in South Africa, can also then be claimed as if it was incurred. Because we tax you on a worldwide basis, expenses is on a worldwide basis.
Are there any specific reporting requirements or forms that South African expats need to be aware of?
Oh, yes. So they're not really special forms, but it's a principle of we must always declare gross to the taxman, and then you claim the exemption. So the 1.25 million, you can't just leave it off your tax return. You must first of all declare it on your tax return, claim the exemption, show that you meet the 183 days and the minimum of 60 days consecutive. On the other hand, we have Reserve Bank rules. Okay. Now, the Reserve Bank says what you earned that side or the 10 million foreign allowance you took out can stay there, but you must report it to SARS. If you remit that money into South Africa, there's a specifically, we call it BOP, balance of payment code, that you'd have to tell the Reserve Bank why you're bringing the money in or why you're taking it out. Then at your own bank, if you have foreign investments, it is often important, or you inherited something, important to tell them, because otherwise they're going to send a suspicious report to the Financial Intelligence Center and says, we have no record that this man has foreign assets or should have foreign assets, but he keeps on sending money into South Africa. So it's not special forms as such, it's a compliance that is very important. The other one part that must not be forgotten is that there's special returns by banks. We call it common reporting standards. If you open a bank account, even in the Isle of Man that's tax-free, they're going to tell SARS that you have a bank account. So some of that reports are not generated by you, it's generated by someone else.
How does the double taxation agreement, DTA, affect South African expatriate taxation?
Okay. First of all, remember you must be tax resident to claim the 1.25 million. But the better option for most people is to actually claim the treaty benefits and then exit South Africa as a resident. You remain a passport holder, you remain an ID holder, but you are not paying tax to South Africa on a worldwide basis. But then there are people like pilots, onboard crew, that they prefer to stay a resident and they then claim the treaty exemption because treaty rules override South African law. The other advantage we have is that often in the tax treaties, there are allocation of taxing rights. So for example, if you buy a property in the UK has the first right to do the capital gains tax. Their capital gains tax is 28% on second properties. Our capital gains tax max 18%. And it could be on your first property above 2 million gain or on all holiday homes. So because their tax rate is more than ours, you then claim in terms of the treaty, the tax credit. And now because you've paid more than 18%, SARS won't refund you, but you won't have to top up in South Africa. So there's various different options within a treaty. It's either taxing rights, tax credits, or the tax immigration.
What are the penalties for non-compliance with South African expat tax regulations?
So first of all, if you do not declare or underdeclare, the penalty can be as high as 300%. But we don't really see SARS doing it on the first offense. They normally go 50 to 100%. But there's ways that if you have not disclosed it, that we can go to SARS and we do a voluntary disclosure. It's like an amnesty. Then they won't raise penalties, provided you come to them before they catch you. If you have failed to file tax returns, then there's still administrative penalty as well. Can be as high as 6,000 Rand per tax year, or 36,000 Rand in total. But we also have the situation that, and we've seen it recently with a well-known film star who did not file tax returns. SARS listed that as a criminal offense. Now that makes it very problematic because remember, you can't get a foreign visa, even a holiday visa, once you have a criminal record against you. But we don't know the background of that because once it goes to court, we'll probably know more, because court documents are normally public. But at this stage, we must assume that SARS has issued multiple requests for non-filing, okay? And they have ignored all that because I've only seen SARS going for criminal offenses, on serious VAT fraud and things like that. And now the first time on someone who has not tax filed for 10 years. So they took a long time before they took the steps. But don't rest and say, okay, SARS is going to take 10 years to catch me. It's just not worth it. Because remember, there's also the interest, and SARS interest is not tax deductible, and the interest are prime tax interest rates. So it can be a very expensive exercise. So 6,000 Rand per tax year for not filing, 100% to 300% on the tax you have to pay. And if you're very naughty, you can go to jail. But that's an extreme.
Can South African expats still contribute to a retirement fund in South Africa while they're working abroad?
Oh, absolutely. And if you have no other income, that contributions, you must fill in the tax return, even if you have no income, because every year you record that contribution. It forms like a little balloon. One day when you then retire, your 550,000 exemption on retirement is increased by the amounts you previously did not deduct. Okay, so you must obviously, I give you tax advice. I can't give financial advice. My personal feeling, and it's purely a personal feeling, is that, and I, for example, have a dollar plan because I earn dollars. I go for the hard currency as well. Okay. But if you know you're coming back to South Africa, do not cancel your retirement annuity unless you know there's absolutely no penalties at the fund level, because sometimes funds have penalties.
How do changes in the South African tax law affect expats?
Those changes, and one of them we're seeing now, is that we have expats that have not tax immigrated. And now there's a proposal by SARS. They want that foreign employer paying a South African tax resident in dollars or in rands to become a registered employer in South African law, so that you pay UIF and skills development levy and so on. So SARS, I wouldn't say there's an attack on expats, but they're forever watching that expat space because they just, in principle, don't like people not paying tax. So they are, although they honor the 1.25 million, they feel that there's some people that are getting away. We also have that rule will also impact people that are not expats, but if you have a digital nomad, so it's a guy that lives in England, he just likes our summers, come and stay in South Africa for our summer, but he works for a foreign employer. Now he becomes liable for tax in South Africa because his source is here. So he's not tax resident. He only pays tax in South Africa on the source income, what he earns in South Africa. So SARS also wants his employer to now come and tax register. The other part that impacts us is every year they change the medical aid deduction. They either increase it or decrease it. So that also impacts because many of the expats have a qualifying medical aid, as I explained earlier, or they have continued contributing to their South African pension funds. And also the final point is, remember, I explained that if you live in a country and you're not ordinarily not resident, so you just use a treaty as your benefit, you still have estate duty. So every time they increase or adjust the estate duty, your estate will become to an increased estate duty liability. So about 3 years back, they increased the estate duty for people richer than 30 million. So from 30 million above, they increased the tax rate from 20 to 25%. Doesn't hit everybody. We'd love to be there, but it doesn't hit anybody, but everybody, but those who are above 30 million, it hurts. Now, why I mention that is many of the South Africans, they only think of their South African assets. They think South Africa will only tax them on their South African assets, but estate duty is on worldwide assets. And if you convert that 10,000, well, let's look at $1 million investment, it's immediately 18 million in South Africa. So you're halfway to your 30 million, add your house, add your life insurance. So 30 million is not that far out of reach of the middle class South African.
Can South African expats transfer their foreign pensions or retirement savings back to South Africa?
Yes, they can. Whether it's tax advisable, I don't think so. So we have a general rule, your foreign pension that you contributed to whilst outside South Africa will remain tax-free in South Africa. But the minute you move it to a South African fund, then if you're a resident, that resignation from that other fund is taxed because it's a lump sum. If you're below 55, 27,500 is tax exempt. If you're above 55, 550,000. But the rest is then taxed as a lump sum. You can then put it into either a South African pension fund and get all that benefit, or you can put it in what we call discretionary fund, a unit trust. So yes, it's totally legal, but whether it's tax advisable, I don't know. Obviously, you must also then speak to your investment advisor, because then from an investment advisory perspective, there may be better growth opportunities in dollars. But remember, if you invest in cash, very few dollar accounts give you much interest more than 2-3%. Where if you're in rands, you can get sometimes 7-8%. So there's so many factors, but totally legal to remit to South Africa.
What are the tax implications of maintaining a home or property in South Africa while you are working or living abroad?
So it all depends what you do with the house. If you have the house and one of your family members or your children stay there while they go to varsity, no tax implications, but you can't get the expenses as a deduction. If you rent the property out, then the rental income is taxed because it's not part of remuneration, so it's not part of the 1.25 million, but you can deduct your interest that you pay in your mortgage bond, your rates and taxes. So there's a little bit of a difference because before the expat left, he can recall that in the COVID time, you could deduct home expenses. But for home expenses, you can't claim interest. But when you rent out, then you can claim mortgage interest. So it is taxed net after allowable expenses.
How does South African expat tax apply to individuals who are citizens of South Africa but not tax residents?
So if they don't live in South Africa, then they normally not tax resident, and then only what we call source income. If they have a property they rent out, yeah, then they're taxed. We, unlike America tax you just because you're South American. We do not have that system. So you can have a South African ID number, you don't have to give up your passport and be tax non-resident, either on a treaty principle or as no longer ordinarily resident. That's typically someone who has a South African passport and a second or dual passport, or someone who has a UK indefinite leave to remain, ALR, an American green card, or these golden visas in Europe, like Spain or Portugal.
Are there any tax incentives or concessions available to South African expats?
No, not really. So over and above this 1.25 million, there's not much more. Okay. We are fighting that, as I explained earlier, that these flights between your place of employment and South Africa be tax exempt. We hear in the corridors that in some cases where people have claimed that exempt, SARS did not fight it. But currently tax law says any traveling between home and office is taxable and not a deductible expense. But other than the 1.25 million, there's not much more. And then remember, as we mentioned before, if you belong to a qualifying foreign pension or medical fund, then you can claim the deductions here. But the big benefit for people doing expat work is, first of all, you're not subject to BEE rules, or that country normally doesn't have BEE rules. You're earning in a hard currency, and you can keep the money abroad, and you can bring it back legally to South Africa. So the expat employment options are more based on foreign earnings or alternative employment. The tax is a consequence. I always say to people, never make a decision purely about the tax. If you just want to go and work abroad or on a ship or a vessel just because of the tax breaks, I don't know if you really thought it through, because, you know, you're away from your family. I experience it. Anton and I, my husband, we spent 6 months a year outside South Africa. We're currently in Calitzdorp, and we had such a wonderful weekend here that you just want to come back. And then you think, oh, there's this hard currency to be earned. So I don't know, for me, it's always this, you know, I have to weigh up. And our decision is just, you know, we're both 60. At our age, as long as health allows, we'll do it. And if health doesn't allow it, we'll come back. We're not going to risk our health by staying in countries that doesn't have our private health system, because, you know, sometimes the government health systems in other countries are worse than ours. We often think of all the problems in South Africa, but believe me, once you've traveled, you see the problems in another country.
What are some common mistakes or misconceptions about South African expat tax that expatriates should be aware of?
The biggest for me, Livio, is wills, and you may be living in a country that does not acknowledge same-sex relationships. So, for example, in the UAE, Anton and I are there on total different visas. We can't be there as a couple. Okay. So therefore, our will in South Africa is a joint will. We bequeath to each other, and we're going to claim the surviving spouse will claim the spousal rollover, because SARS allows for that. In the other country, we then have a will that says we bequeath to each other, but that will must clearly state that it does not include or deal with South African assets, and it does not revoke my South African will. So for expats, my suggestion is a will in every country where you hold an asset or employment. That is my biggest issue. The second part is also think on what we call the probate, or the process when you die. If you can have a joint bank account, because then your surviving spouse can just draw the money out without going to register the estate. But if you do not have a joint account, then you have to go in England, for example, for a probate. And if you have 10,000 Rand in the bank, 10,000 pounds in the bank account, the probate cost is 15,000 minimum. So there's your money gone. You know, so it's a lot of pre-planning, and that's where I invite our friends and colleagues and fellow same-sex marriage couples to approach us, because it's not easy, but there are solutions. The big one, as I said, make sure your will covers South Africa, the foreign will excludes South African assets, and the one doesn't revoke the other.
Thank you so much. I really do appreciate it. I've learned again a few more interesting things, and it's so interesting to hear all the different new laws, and actually that we live in such a good country still. Although we are going through a bit of bad times, but I believe we'll be getting better soon.
You know, sitting in Dubai, we often, when we complain about the load shedding because the friends at South Africa can't speak to us, their phones are pop, the battery is pop, or the internet is down or slow. Then our friends in India says to us, and Lebanon, you know, we only have power 2 hours a day. Why are you complaining about 4 hours without power? You know, so that is an interesting thing. And I'll tell you, our weather is still better. You know, so it's a bit cold today in Calitzdorp, but the weekend we had the most gorgeous weather. And, you know, going back to Dubai now, end of September, it's not 52 anymore, but it's still like 42 to 45, which means you can't really go outside. So it takes something to get used to that saying in Dubai, we can't wait for winter because we can braai. So their biggest issue at the moment is there's World Cup and they can't braai because it's too hot outside.
That's so interesting. Thank you again for your time. I appreciate it.
My pleasure. And thanks a million. And as I said, Livio, anyone who feels that they just want to reach out and ask some comments, welcome to do that. That's our commitment to your radio station and your listeners. We'll just guide them. Maybe we don't have the answers, but we have a network of people that can provide answers.
Just before we go, could you just give us how they can contact you?
Okay, the easiest is I am on Twitter and social media as Taxfourm, Taxfourm. It's behind me. And then we also have the 22, okay, on the social media. And my email address is really, really easy. It is Hugo at taxfourm.coza, not .com. Okay.
All right. Thank you so much.
Thanks a million, Livio. And although we can't always listen to you because you won't believe, even in Dubai, your radio station streaming is blocked. Unless you use a VPN, we can't always listen to you. So I get my friends and family to say, how's the advert we're doing sounding? Is it working? So thank you for you supporting us despite not being in the country. So good luck with you and the radio station. And thank you what you're doing for the community.
Well, thank you. Thanks a lot.
Thanks a million.
Okay.
Cheers.
Okay,
Bye-bye.
bye.